Hello friends. Now in this study session, I'm going to continue with our working capital and liquidity management learning module of corporate issuer. We will try to complete our second learning outcome, that is explain liquidity and compare issuers liquidity levels. Very easy topic. 2-3 type of practical questions including numerical question we may get in exam. So let's start with the topic liquidity. First of all, what do we mean by the term liquidity? So liquidity can be explained in two ways. First, in respect of an asset or a liability. So with respect to a specific asset or liability, it means its nearness to cash or settlement. How quickly that asset can be converted into or realized into cash. And in case of liability, how quickly we will be required to settle it by paying cash. So from a specific asset or a liability point of view, it is the nearness of that asset or liability to the cash. How quickly realized or payment is required for that asset or liability. So if we classify different type of asset from our balance sheet, the first one is cash itself. So cash is the ultimate liquid asset. It is already in form of cash. So it's the most liquid asset. Next liquid asset, if we categorize, the next liquid asset will be your short-term marketable security. They are generally treated as cash equivalent. Why they are generally treated as cash equivalent? Because the investment which will be classified under short-term marketable securities, they will be readily realizable. First of all, quickly you can liquidate it, readily realizable with insignificant risk of loss. So there should be very minimum chances of decrease in the valuation of those assets. Then these short-term marketable securities are classified as cash equivalent. So this is the second liquid asset we hold in our balance sheet. Next, we hold another current assets, another type of current assets. These are your inventory and receivable. Now, comparing these inventory and receivable from the point of view of liquidity characteristic, which asset, though both are current asset, which asset can be quickly converted into cash? Of course, it will be receivable. Why? We have given a credit period, let's say for 3 months, but still by offering them a prompt payment discount, we say cash discount, we can motivate them to pay early. But in case of inventory, we cannot make it compulsory for our customer to purchase goods from us. So since we cannot force customer to purchase goods from us, inventory will be treated as less liquid in comparison to receivables. Next one is your fixed asset, tangible and intangible, plant machinery, building, and your copyright, trademark. Again, comparing fixed asset versus current asset, of course, it will be even more difficult to sell your plant machinery and building in comparison to your inventory. So from liquidity point of view, most liquid is your cash. Next one will be your short-term marketable security. Then is your receivables, inventory, followed by your fixed asset, tangible and then intangible. From liability standpoint of view, the most liquid liability which you will be required to settle very quickly is your liability towards your purchases. That is your creditors for your purchases, suppliers, due to suppliers, because suppliers have given you, let's say, 2 months credit. You need to pay within 2 months, otherwise they will not sell raw material to you. So generally suppliers liability is treated as most liquid liability. Next is your accrued expenses. You have taken benefit, but the due date of payment is still not come. So in that case, you can delay till that due date. So second liquid liability in terms of liquidity is your accrued expenses. Will be followed by your short-term borrowings from your bank in form of overdraft or cash credit. Then your long-term borrowing, because that will be required to be paid after 5 year, 10 year down the line. Next will be, last one will be the most illiquid liabilities, equity, because equity you need to pay only at the time of closing your business, winding up your business. So from liquidity standpoint of view, we have already categorized these assets and liabilities. Now next is second way of defining liquidity is liquidity from an issuer point of view. Whether issuer is having liquidity or not. What do we mean by that? It means that issuer's ability, first of all, from asset liability point of view, it is the nearness to cash or settlement. From issuer point of view, it refers to ability to meet its short-term liabilities. Whether issuer will be able to pay off their short-term obligations or not. When issuer will be able to pay off their short-term obligation easily when they are holding liquid assets with them. More liquid assets an issuer is holding, that issuer's liquidity position will be good. Less liquid asset an issuer is holding, its liquidity position will be worse. So it refers to how quickly you can, what is your capacity, ability to meet out your short-term obligation. So from where you are going to pay these short-term obligation, what are the sources of liquidity? Now here we may get first question. First type of question where they will give certain type of transaction and they will ask you to classify whether these are primary or secondary source of liquidity. We will classify our liquidity sources into two parts. That is your primary source and second is your secondary source. What do we mean by primary source? The first source which we will always try to use. So first primary source, very easy. Only three sources are categorized as your primary source. Remaining everything is your secondary source. And if a business is using secondary sources of liquidity for paying off their short-term obligation, it is generally treated as a negative signal for the market, for the investors. It means the primary sources of business are not sufficient to pay even short-term obligations, then what will happen for long-term obligations? Generally treated as negative activity if any business is using secondary sources. Number one, primary source is your cash and marketable securities, that is cash and cash equivalent, what you are already holding in your hand. So that is the first thing which we will be using for paying off our obligation, short-term obligation. Cash is already in hand, balance in the bank can be used by issuing checks, and the short-term marketable security which are readily realizable with a negligible risk of loss, they will be next used by selling those marketable securities in the market. Next, if your cash is over, your bank balance is over, your marketable securities are already used, next source, primary source, where business will go? Business will go for another borrowing. Now, another borrowing is, yes, we may use it for our payment of our short-term obligation, but it itself will create another obligation for payment at some future point of time. The third primary source which business will be using is the cash flow generating from operations. Business, we are doing business transaction, purchases, production, sales, we are employing workers, doing sales, marketing, all type of activity we are doing. So from these activity, we must be generating some cash, which can be used rather than paying off your investor dividend, etc. This cash can be used for paying your short-term obligation. So the cash which is generated from operations is the next primary source. But for seasoned, matured business, yes, business will be generating positive cash flow. But for growing startup business, initially, generally business do cash burn, so there will be negative cash. This source will not be available for them. Next, secondary sources. What are the secondary sources from where you can get liquidity for paying off your obligations? Number one, hold back your equity dividends. Hold back your equity dividends. You cannot hold back interest. That is the payment to your lenders, financiers. So that you cannot hold. But dividend, it is choice with the company whether they want to retain it or whether they want to pay it. So this can be a source of liquidity by holding back your money, by holding back your dividend. So no payment will be required to be made to shareholders. So this money can be used for payment of your short-term obligations. Second, delay or reduce capital expenditure. Very negative from long-term point of view, because if you are not investing in your capital assets, then your future productivity will deteriorate. But still, in difficult situations, difficult time, you can delay or post or cancel your capital investment, and you can route that liquidity, whatever is available for your capital assets, to for your payment of your short-term obligation. Next, if both are not available now, no profit is available, no retained profit is available for payment of dividend, so this is not a source. Second, there is no funds available for capex, capital expenditure, then from where you are going to generate your liquidity? Your primary source are already utilized. Issue equity shares. Again, this is a negative, because for existing shareholder there will be a dilution of control. Next, if now issue of equity is also not possible, now what you can do? You can sell your assets, your fixed assets, at discount. Of course, the new buyer will not give you the fair value. They will give value less than the fair value, because you are in need. So you have to sell your asset at lower value, lower than your fair value, lower than the fair value of your asset. Again, a negative case for business. Next, renegotiate contracts with your debt holders, your lease agreement. So you have to renegotiate with your customers, suppliers. So this is the second way, secondary source. You can renegotiate, sir. You have to we will be delaying payment to we have to say this to supplier, and this is again going to create a negative impression for from supplier point of view. Last one, if nothing is working out, now you can take help of law by going for filing for bankruptcy protection and reorganization, where all payments will be deferred to make business sustain. So that can be the last source, ultimate source for your liquidity. Of course, using the secondary source of liquidity is going to create negative signals in the market, in the investor community. Next, so what type of question we may get? Number one, they may give you activity and they may ask you whether it is a primary source or secondary source. And one numerical example, let's take that numerical example. Calculate how much liquidity can be raised from following sources. They will give different sources. Fair value is available, and now liquidation cost, that is the cost of administering that sale of these assets, brokerage, etc. And of course, we are not going to get the fair value because we are going for a distress sale. So in that case, there will be lesser value will be realized. So in that case, what will be your cost? 100, 5%, 5 million, 16 million, 50 million, 400 into 50, 60 million, total is 160, 26, 131. Net proceed, how much we are receiving? Net proceed, in this case 95, 184, 500 less this 450, and last one is 340. So total here it is 4, 9, 11, 12, 1200 millions minus your cost 131. So you will be receiving how much? 9 and 9, 18 and 8. 95 plus 184 plus 450 plus 340. 1069 plus 131 is your cost. So 1200 is your total fair value of the asset. So by selling all these assets, sell short-term marketable security first, second inventories and receivable. This is not actual sale. This is you are selling inventory at discounts to generate liquidity. Next, excess real estate. You are selling excess fixed assets which you are not using, or you are selling your investment in your subsidiary. Again, you will be getting lesser than your fair value. So total liquidity you will be generating is 1069. Very easy question, simple mathematics is there. Next, now after understanding different sources of liquidity, they may ask you to calculate different measures of liquidity. How to calculate, how to quantify how much liquidity is available. There are two ways. Number one, absolute measures, and second is relative measures. Absolute measures means there will be a number that this much liquidity is available. And second, relative measure means we are going to use some ratios with respect to our obligations. So let's go for absolute measure. Very simple. The first measure which generally used is cash flow from operation. It represents actually cash profit. How much cash profit business is generating from its activities. So from where we are receiving cash, it's actually your cash which you are realizing from your operating general activities, business primary activities, primary business activities, whatever cash inflow and outflow, this is the net value of that. So what are the business primary activities? We receive money from our debtors and cash sales, that is your receipt from receivables. Second, we receive sometime interest and dividend on our financial investment, what our business has done with other. Next, we have to pay some amount to suppliers for raw material, to employees, for expenses, interest, and taxes also. So this is the net cash which we are generating from our primary activities of the business, and this is your one of the primary source of your liquidity. Sometimes different absolute measures are used. Second absolute measure is free cash flow. Now this term is used at various places in our study material. Free cash flow. What do we mean by free cash flow? How much cash is now available, freely available, after paying off everything, whatever is required, including your capex, including your capital expenditure. So from cash flow from operation, we have already paid all our expenses. Suppliers due, your employees due, your interest on debt also, your taxation, your other expenses also. Now what is next due is your payment for your capital expenditure. So from cash flow from operation, if you deduct investment in your long-term asset, this is called as free cash flow. Free cash flow for payment to everyone, your debt holder, your equity holder, whatever you can do with this cash. Whatever this cash is free for any use with the business. Last one, sometimes they ask free cash flow from combined point of view, equity as well as debt. In cash flow from operation, we have subtracted interest on debt. So this interest on debt is also available for debt holder only, na? So that we are adding it back, so that the overall gross amount which is available for both debt and equity is available. So what we are doing, free cash flow, not from cash flow from operation. So free cash flow already deducted capex expenditure plus interest on debt paid, which we have deducted in first value, that is cash flow from operation. So these are absolute measure. May come a simple question where they will give different transaction and you have to arrange it and solve these numbers, solve these equations. So let's go for next part. Second, relative measures. What are the relative measures? Yes, here we will get some question, numerical question again. There are three ratios which are generally used for measuring the liquidity position of an issuer. What are these three ratios? And these ratios will become more conservative as we go down. The first one, the broad measure of liquidity, relative measure, how much liquidity we hold versus the payment which we have to do in short-term as our short-term obligations. The first broad measure is your current ratio. What do we mean by current ratio? It is the relationship of your current assets. Current assets include your cash, marketable security, your inventories, your receivables, and your prepaid expenses. The definition of current asset is all assets which we intend or expect to realize means convert into cash within one operating cycle, versus in comparison to with respect to current liabilities. What do we mean by current liabilities? All liabilities which we intend or we have a legal obligation to settle within one operating cycle. This is the current liability. So how much value of asset we hold which will be converted into cash in one operating cycle versus how much liability we have to settle within one operating cycle. The relation of these two is called as current ratio. The first category is called as current asset. The second category is called as current liability. So it is the ratio of current asset with respect to current liabilities. It will be in times. Now question is, higher the better or lower the better? X company is having 2 times current ratio, Y is having 3 times current ratio. What it means, for every 1 rupee liability, current liability, short-term obligation, we are holding, X is holding 2 rupees and Y is holding 3 rupees. So who is having better capability? It is the Y. So higher the better. Not higher the better, I'll say higher the current ratio, higher is the liquidity availability. Next, quick ratio, a bit conservative. Why? What is the difference? The difference is here, in current asset, we are including cash and cash equivalent. We are including, that is short-term marketable securities. We are including receivables. We are including inventories. And we are also including prepaid expenses. We are also including prepaid expenses. Now, whether we can convert quickly our inventories, our prepaid expenses, can we convert them? No, because we cannot force our customer to purchase goods from us. So if we cannot force, we cannot quickly convert them. It depends on their choice, customer's choice, which is out of our control. And prepaid expenses are generally not refundable. So these two are not classified as quick assets. So here we will be using the remaining current assets, that is cash, cash equivalent, that is your short-term marketable security, and receivable as numerator with respect to your current liability. The denominator is same. So this number will be lower than your current ratio, but it shows how much quick assets, we say quick assets you are having to pay off your short-term obligation, which are readily available, the money which is readily available. More conservative is your cash ratio. Now again, receivables, they are also not in your control. You can motivate them for prompt payment, but you cannot force them to accept cash discount. So we are removing receivables also from the numerator. Now what is left is cash and short-term marketable security, that is cash and actual cash equivalent, which are readily available, versus with respect to your current liability. So let's calculate these numbers and let's find out the situation of a company. So we have XYZ Limited. Balance sheet of XYZ Limited is available with us. We have assets. The current year and the previous year data is available. Cash. Now this from issuer point of view, balance sheet, generally the most liquid value is at the top, and as the liquidity reduces, the item will be coming in your balance sheet. So cash, most liquid, marketable security or short-term investment, these are cash equivalent. Then receivables, inventory, we have already discussed the sequence why receivables will be above inventory. You cannot force your customer to purchase inventory to generate liquidity for you. Then prepaid, these are generally not refundable. These are generally the insurance expenses which we have already paid for coverage for a particular period. Property, plant and equipment, your fixed asset, these are not at all your current assets. So till here we have current assets. Till here these are current asset. Till here we have quick assets. And this part is your cash and cash equivalent. What are the current liabilities? Accounts payable to be settled in one operating cycle, accrued and outstanding expenses, and your short-term borrowing. All these are your current liabilities. We have to calculate current ratio, quick ratio, and cash ratio for both the years. Let's calculate for both the year 2025 and 2024. So 2025 and 2024. What is your cash and cash equivalent? Your short-term marketable security value, it is first case 200 and 300, 500. Second case 250 and 350, 600. Okay, reducing. Then your quick assets, which will include your receivables also now. So 200, 300 and 400, total 900. And here it is 1050, 600 plus 450 is 1050. And last, your total current assets is your 550 will be more added. So 550 is your 1450. 1450 plus 250 is your 1617, correct. And here we are going to add 230. 230 is 1280. 1280. Now what are the current liability? 1280 plus 950 plus 220. 1290, 440. Now what are the current liability? 500, 750. And here 400, 500, 550. Let's calculate first current ratio. Current ratio, which is current assets upon current liabilities. This is 1450 divided by 750. We have 1.933. Next one is 1280 divided by 550. So 1280 divided by 550, we have 2.3273. It means year on year from 2024 to 2025, the liquidity position is reducing. Earlier, for every 1 rupee of obligation, we were holding 2.32 rupees of current assets, whereas now we are holding only 1.933. Next one is your quick ratio. This is your quick assets upon current liability. 900 over 750, it's a more conservative ratio. 900 divided by 750, 1.20, whereas here it is 1050 upon 550. 1050 upon 550. So again, it is reducing YOY. Year on year, it is reducing. And last one is your cash ratio, which is your cash and cash equivalent divided by your current liability. That is 500 over 750. Very difficult situation because we are holding less than 1 rupee for every 1 rupee of liability, 0.6667. And here in this case, 600 over 550 is equals to 1.09091. So comparing these three ratio year on year, the liquidity is reducing for this company, and I hope everyone understood the formulas and why. First, your current ratio is using current asset, all current asset, including your prepaid inventories. Quick ratio, we are not going to include inventory and prepaid because they are not quickly convertible into cash. Inventory, you cannot force your customer to purchase and generate liquidity for you. And second, prepaid, they are generally non-refundable. You have already paid to avail services, to avail benefit in future. So they are generally non-refundable, not convertible into, quickly convertible into cash. That's why they are not part of quick assets. And last one is cash ratio, the most conservative, how much actual cash and cash equivalent you are holding with respect to your short-term obligations. So this is the next practical question, numerical question we may get. Next part is, so three measures, absolute measures: cash flow from operation, your primary activities, what cash they are generating. Second, free cash flow, that is cash flow from operation excluding less your capex. And cash flow for debt and equity combined. So since we have already deducted interest while calculating cash flow from operation, we will add it back from in the free cash flow. Three relative measures of liquidity that we are already done. The next part is, what are the drags and pulls on the liquidity? So what now here, what type of question we will get? First of all, they will give certain activities and ask to classify them into whether it is a pull or a drag, or is it going to increase the liquidity. So different activities in the business are going to have different effect. You will increase liquidity, you will decrease liquidity. Now we understand liquidity means availability of our cash and cash equivalent and your current assets to pay off our short-term liabilities. So few activities will increase the liquidity capability to pay, and few activities will decrease liquidity capability to pay your short-term liability. So the activity which are going to decrease the liquidity can be further subclassified into two parts. One is called as drags on liquidity. Second is called as pulls on liquidity. These are going to decrease the liquidity. So what they can do, they can give certain transaction and they will say whether it is drag, pull or increasing the liquidity. For example, giving prompt payment discount to your customer is going to increase or decrease the liquidity. Of course, when you are going to give prompt payment discount, customer will be more motivated to pay. So if they are more motivated to pay, then you will realize cash very quickly. So this is going to increase liquidity. But if you are changing your credit term, if you are changing your credit term from 110 net 45 to 110 net 60, you are increasing net days from 45 to 60 days. So now the person, the customer receivable who is paying by 45th day will avail extra 15 days. So this is going to decrease the liquidity. So these type of transaction will be there, where they will ask whether what is the effect of this transaction, increase, decrease, and decrease again in what form? Is it a pull or a drag on liquidity? So now let's define what is drag on liquidity and what is pull on liquidity. Drag on liquidity is any transaction or event which is going to reduce liquidity, decrease liquidity in the form of decreasing cash inflow, or these are cash inflow lags. It means the money which is supposed to come, now it is going to come with a delay. If money which is supposed to come is going to come late, there will be a delay, it is going to decrease liquidity. These are related to your inflow transaction, and inflow is coming with a delay. These are called as drags on liquidity. Next is pulls on liquidity. These involve an acceleration of cash outflow, where you will be required to pay early. So since you are required to pay early, this is again going to further decrease your liquidity, because now less cash will be available for your remaining liabilities, your remaining obligation. So both lag in receipt or acceleration in payment are going to reduce your liquidity. In example is, if we avail prompt payment discount offered by our supplier, those supplier gave us a 1 month credit, but now they are saying if you pay in 5 days, we will give a 1% discount. And if we opt for accepting that discount, we will be paying within 5 days. So the payment which was supposed to be done at the end of 1 month, 30th day, now we are paying at 5th day. So we are accelerating the payment. This is going to reduce liquidity, because this is going to reduce cash in our hand, current asset in our hand. So this type of reduction in liquidity, this activity is called as pulls on liquidity. So different type of transaction they may give you, and they may ask you which transaction will be categorized as pull, drag, or which will have a increase effect on the liquidity. So one very crystal clear difference: inflow related reduction in liquidity are drags, outflow related reduction in liquidity, that is acceleration of payment, are pulls on liquidity. So let's understand these transactions. Number one, these are cash inflows. First, drags on liquidity. These are cash inflows lag, creating a shortfall due to decline in available funds. First, receivable issue. When you are not able to collect receivable or payment is coming with a delay, these are called as your drags. Second, inventory issue. Obsolete inventory you are not able to turn around quickly, then it is again a drag on liquidity, because inventory is becoming obsolete. Technologically obsolescence or commercial obsolescence is coming. Next, cash issue. This is important. Borrowing constraint, not on us individual, as an individual company or an individual firm. Borrowing constraint, the credit condition tighten due to adverse economic conditions. There is a shortfall of money in the economy as a whole. So if there is a shortfall of money in the economy as a whole, there will be less borrowings available for us. And borrowing is one of the primary source. This is going to create a decrease in your liquid availability of funds, so which you can use by getting the funds from borrowing. So this is going to be called as a drag on liquidity. Next is pulse on liquidity. Making quick payments, early payment to your suppliers, employees and others before the due date to avail sometime discount. Reduce credit limit. Banks is reducing your credit limit because of the credit quality issues. Limit on short-term lines of credit. Again, same reasons. Maybe because of government mandate regulations, new regulations. It's not the economic issue. It's the government regulation which is creating less availability of funds, or you are required to pay quickly to your banks. Low liquidity position due to industry condition or weak financial positions. So it's not again an economic issue, not a macro issue. It is specific related to your industry where you are required to pay quickly or you are not able to get the money. So this where the money is pulled back from you, that is why these are called as pulls on liquidity. So what we have already covered, we have covered 4 topics, I think. Number 1, what is liquidity? What are the sources of liquidity? Number 2, what are the absolute measures of liquidity? Number 3, what are the relative measures of liquidity? And last, what do we mean by drags and pulls on the liquidity? There are practical questions related to drags and pulls in our study mat. Please do practice from that. And very crystal clear inflow related issues, your receivable, your inventory or economic issues are drags. Other than that, payment related issues are your pulls on liquidity. So hopefully everyone understood it. Thank you so much. Thank you everyone.